Hey guys, had a quick question from a viewer about how to cost average down and the different methods that one can use. So I have here the chart for SoFi, and we'll look at the possible plays that you can do to cost average down. So in this situation, let's say you bought somewhere around here, and let's say your cost average was $24, just to keep it simple. And SoFi is currently at $15.30, so you are about $9 above. You paid $9 more than the current price, and you're kind of freaked out about it. So you want to cost average down, or maybe you want to try to exit the position altogether. So we'll look at the different ways to try to get the most bang for your buck here. To do this, you do need to hold for some of the plays, you do need to have at least 100 shares because we are going to be using options. Or if you don't have 100 shares, you could just try to do this through brute force and timing. Brute force and timing is simply looking at, instead of looking at the daily, we'll look at the minute-to-minute chart. So kind of brute force and timing. This is difficult because you are going to have to be watching the stock fairly closely. There is, I would say, definitely more risk involved in this method. But what you would want to be doing is trying to sell during the high, so 16.19, and trying to buy in again at the low of the day. If you are unable to do day trades, then you will then need to look at this for a multi-day process. So we'll look at the previous day. So if you're able to sell at 16.42 and then buy in at 15.22, you'll be saving about $1 a share. You'll probably be able to get about 8 more shares than you did before, or you could just keep it at 100 and try to just pocket the rest. So if you sold 100 here, you'd be getting paid 16.42. And then if you buy in again at 15.22, then you'll have $120 difference. So you can use that to buy more shares, or you can just again keep that cash and just try to keep your stake at, let's say, 100 shares. Now the problem with this method is that this is a high and this is a low. Timing this is nearly impossible. If you could time this in the first place, then you probably would not be in the situation you are. So this is kind of a brute force method. It is very hit or miss because you can always mistime things and be kind of caught out in the cold. For example, let's say you sold at like 16.42 or even like 16, thinking that it will continue to go down. But if it goes up, then you are at a loss. You're either going to be kicking yourself and then buying in with and getting less shares than the 100 that you originally paid for, or you will just have less money overall. So let's see, we can look at the daily again. So for example, if you were somewhere around here and you were trying to play this, but you got caught here. So let's say you were cost averaging down on these dailies, trying to get in and out, in and out, in and out, but then there's a sudden rise in price, then you will be losing out on that. So we're going to look at some other possible ways to do this, where you either won't get stuck, either holding at too high a price, or you won't get stuck if it suddenly does a climb upwards. So the first thing is to do selling covered calls. So we're going to go into options here, and we're going to look at the calls. So again, we are saying that you bought in, you have 100 shares with a cost average of $24. And today is July 17th, so we're going to be looking at the next monthly call options, which is going to be August 20th. Now, August 20th, we'll be looking at, you do want to go about, I'd say about 10%, 5 to 10% above your what you paid. Again, the current price is at 15, so if you can get out with, you know, at this point, a lot of people are going to be like, I just want to get out with, I just want to break even. Or I just want to see green and I'm out, I'm done, this is too volatile for me. So we're going to be looking at 25 here. So 25 means that it's about a 5%, a little bit less than 5% from what you paid. If you paid $24, that means you paid a 5% increase would be $1.20, but we'll look at 25 since the next jump is a little bit too high at 30. So what you would be doing is you would be selling a covered call. Since you have the 100 shares, you'll be selling a $25 premium covered call, and that will net you, let's say, $110. So you'll be paid a premium of $110 for that covered call. That does mean that you do need to hold on to those shares until the contract either closes or it expires. And so here, if the price drops even further, or it rises a little bit but doesn't get to your 24 breaking point, then you don't lose anything. Anything under $25, again, is out of the money, so you're not losing anything, you are actually gaining. You're getting your $110 premium. Again, you are stuck in that position since it's a covered call for a month or a little bit over a month until August 20th, but you are getting paid to hold that position for $110. So best case scenario, it's just out of the money, you collect your premium of $110 and you're done. Now, worst case scenario is that SoFi goes beyond $25 per share on August 20th. And that would mean that you would need to, someone would pay you $25 a share for your 100 shares, whether it's $30 a share on market, or $35 or $40 or whatever. So you are losing out on possible gains, but you have to remember that you paid $24 a share, you are getting paid $25 a share, and you received your premium. So overall, you'll be making off those 100 shares $210. And remember, you were in a situation where you thought you had lost about $900 because you bought at 24. It's currently 15 something. So you're down 900, and this way you are now up 200. So the worst case scenario, you make $200. So not a bad way to kind of reassure yourself and make some money off of your losses so far. All right, second option, or second thing you can do concerning options is to sell a covered put. This does mean that you do need to have the cash available to purchase this if it is if it is in the money for the person buying the put. Sorry, puts are always a little bit confusing. So what you would do is you would be looking at SoFi is currently at $15.30, so you'll be selling a put at $15. And when you sell the put at $15, even though the last price and the mid price is $118, we'll say $120 just to keep the math simple. So you are getting a premium of $120, $120 a share, $1.20 a share, so $120. And this is giving you the obligation to buy 100 shares at $15. So if the price were to fall under $15, someone could obligate you to purchase their shares, their 100 shares, for $15 each. Now in this situation, again, if it is out of the money, which it currently is, then you will receive your premium, or you will get to keep your premium, but you will not be obligated to do anything because it is out of the money. Now, if the put is in the money, so it is less than $15, let's say it drops to $14 per share on expiration date, which is again August 20th, then you'll be obligated to buy 100 shares of $15, so that will cost you $1,500. But you do have to remember you did receive a premium of $120, so out of the pocket money is $1,380. So $1,380, which would equate to you having a purchase price of $13.80 per share for 100 shares. Now, you might be kind of kicking yourself going, oh my gosh, this is a horrible situation. But what you have to think again is that you are looking to cost average down. Remember, you're holding 100 shares at $24. Well, if this were to happen and you had a run of bad luck and you had to buy those shares, well, now you have 200 shares of SoFi, but your cost average has changed from $24 to $18.90 a share. Because again, you have your first 100 at $24, and then you have your second 100 at $13.80, so your cost average is now $18.90, and then you have 200 shares. Now, nice thing about this is that, again, if the price were to go up, which I'm assuming that you hope it does because you already have 100 shares, if the price were to go up or even stay at $15.30, you will collect your premium of $120, and that will be it. You have no obligations to do anything. So you are playing both sides of this position. So you are saying that as long as the price is above $15, and then when we talk about the calls again, and as long as it is below $25, so you have a $10 range where the price can fall within the next month, and you will get to collect premiums and be under no obligation to do anything. If, again, the price were to go up beyond $25 on your covered calls, you would be losing that 100 shares, but you'll be making the premium here, and if you were to also be playing the put, you'd be making the premium here. So if you look at as a total package, you would be getting about $230, plus you'll be selling your shares at $25 a share, which will give you a $100 profit there. So you'll be making about a $300 profit, a little bit over $300 off of shares where, again, you were down $900. So this does require you to have a little bit of money to be able to cover in case the put were to be in the money. And then for the calls, you would have to be holding 100 shares in case that call were in the money. But this is a quick way where if you have the resources, you can cost average down, and definitely safer than doing just a brute force method of buying and selling during the day, swing trading, and hoping that it doesn't go the other way. If it goes the other way, you're looking at either much worse losses or lower gains. Even if you're bullish on SoFi at this point, but you think 25 is a little bit out of reach, or getting back to 24 in the next month is out of reach, this is a very good way for you to cost average down. The only risk is you're risking possible gains. You are not really risking any real losses beyond your current losses of, again, the $9 a share from the original purchase to the current price. So this is a really good way to play with your cost average and bring it down. Again, if you're able to bring it down to $18.90, you might feel a little bit better. And if SoFi is still not doing any movement, again, this is something that you can rinse and repeat every month until you have a cost average that you are comfortable with. Or if you do need to end up covering that call, then you'll just be losing out on your shares. But you'll be losing out on those shares at a profit. So this is a very safe way to kind of play this. All right, guys. That's a little helpful tip for people who feel that they're in a bad position, and hopefully you guys can use it to your advantage. Thanks.